Hey everyone, welcome back to the channel. Today we're going to take a look at doing a quick little valuation of Tesla. Thought this would be an interesting exercise as recently their valuation in the last year has skyrocketed to say the least. So this is just a standard DCF template that we're going to be populating here, and I'll kind of walk you through it as we go through it and show you where we're getting all the data. So first, real quick, we'll just kind of look at Tesla over the last year. You can see, I mean, they went from $71 a share to $610 a share. So I mean, what is that, like a nine times, like a 900% increase. So it's absolutely bonkers. They've gone from like a $80 billion company to a $600 billion company in under a year. So pretty nuts. Thought it'd be interesting to look at kind of the current financials and the situation and see how can we back into something that would give us a valuation of 600 billion. What kind of growth metrics are they going to have to hit? How are they going to have to improve margins, things of that nature. So should definitely be a fun exercise today. So first, we're going to head on over to sec.gov. And this is where you can find all company financials that are publicly traded in the US. Go ahead and hit more search options in the top right. And then when it says enter ticker symbol, just go ahead and type in TSLA for Tesla. And then I'm going to go ahead and just pull up their most recent 10K. You could pull up their most recent Qs. You could pull up the last 3 quarters of Qs, and you could pro forma a Q4 to get a 2020. But I'm just going to look at this as a 2019 basis. And then we'll kind of project out 2020, I guess, just based off historical trends, and kind of ignore the impacts of COVID, even though I'm not sure how much they have been impacted. But once they close the books at the end of this year, I'll update this with 2020 numbers and see if it really changes anything, but it shouldn't be anything super material. So if you go into their most recent 10K, go ahead and click into that, and you'll see, if you're not familiar with the 10K, a lot of great information in here. They file these annually. The 10K will have audited financials, whereas the 10Qs won't be audited, but we'll still have financials in there. And then you can go ahead and click financial statements and supplementary data. I believe this is what we want. Yep, and you'll see here's the balance sheet. They'll provide that for 2 years, so you could go back and you could open up the last one and get 2017. The year before that, get 2016, so forth and so on. And then on the income statement, they actually show 3 years here, so 19, 18, and 17. And then comprehensive loss, but we'll look for the cash flow statement, which is just right here, and the cash flow statement. So I've already went ahead and just copied over these 3 financial statements into Excel, just because that is quite a bit of prep work there on that end. So I've copied them over just so we have the information. And now we'll just go ahead and go through and build out the DCF and kind of see how things are looking and how the company would need to trend to be able to justify its current valuation. And this is a pre-made DCF template. So it's revenues, COGS, gross profit, take out operating expenses, get an EBITDA, D&A, get to EBIT, tax adjusted EBIT, and then from there you add back depreciation, subtract CapEx, and then subtract if it's an increase in net working capital or a decrease, just depending if it's a source or use of cash, and that'll get you your unlevered free cash flow. And then from there you can, we're going to do a perpetuity growth method and subtract out net debt after all of that, and we'll get to an equity value. You can divide that by shares to get the share price, but I usually just look at it on the kind of market cap versus that ending equity value. And then down here on the bottom half, this is just a good spot for a lot of assumptions that we're going to make. So we'll calculate all our assumptions for future years out here, and let me copy that over, headers to copy over. And so yeah, we will be forecasting 10 years. 5 years is probably too short of a period to get any meaningful valuation for Tesla. So yeah, we'll go ahead and start there. So first, automotive revenue. So they break out their revenue by automotive and then by, I'm calling it other, but it's energy and storage and service. But we'll just link up the automotive for now, and we can copy that over. Actually, we'll see here real quick, the number formats on here are in millions, whereas I believe these are in thousands. So what I'm going to do, this is a fun little shortcut if you've never done it. If you type 1,000 and then copy that, you can actually come in to your file and do Alt-ES for your space special. You can do multiply and hit OK. We actually don't want to, that might be a little bit of a a nightmare to clean up, but that's fine. Let me just, some of these real quick need a little bit of cleaning up. Actually, it's actually just going to be easier instead of going through all this. I'll just come to my DCF and change my number formats real quick. That's probably just as easy. Let me just get rid of one of the commas in here. Now it'll be in thousands. There we go. So that works. We can link that stuff up. Usually I'll make the text green if it's linked to another page, just to kind of keep myself kind of organized and understanding what's going on. We'll link up the other revenue. So this one actually has got to be a sum because it's 2 rows on the income statement. So we'll just do the sum of these two for 17. And the formula's a little wonky there. There we go. Close that off. Paste that over. Copy formats real quick. So there we go. And we'll just double check real quick. 11.8, 21.5, 24.6. Does that tie? 11.8, 21.4, 24.5. Yep. So that all ties out there. Then let's go ahead and do COGS now. Let's see here. Link it to that line, and then this one will be a sum. And we'll sum it up of the other 2 COGS here. Let me turn both of those green, copy the formulas over, and then gross profit, let's see if that ties. 2.2, 4, and 4, 1, so that ties. SG&A, so here it's going to have to be a sum. I think they have a couple lines broken out on their income statement. We got, where is it? R&D, SG&A, and restructuring. So we'll just sum those 3, make that green as well, just to keep track. And you'll see my template actually, this line for 2020 would normally represent projected period going after that, but I'm actually just going to quickly add a line here on the left actually as well, just to kind of denote that 2020 is projected as well. So there we go. EBITDA, this is a formula from EBIT, and EBIT is a formula, gross profit less, so you can see we're actually negative here for all of this, which doesn't seem promising, but we'll see what we can get here. D&A, that should be on our statement of cash flows. D&A, here we go. Paste that stuff in, link it up, make it green. There we go. So you'll see EBITDA actually is positive there. And I guess we are cash flow positive here, which is great. CapEx, so this is actually linked up down here. Once again, this will be on the statement of cash flows. Should be under the investing section, purchase PP&E. There we go. I gotta change the formats on this as well, just so we can see what we're looking at here. If you're not familiar with custom formatting, I actually have a video on that as well on the channel, so feel free to check that out to understand a little bit better at some point. And the way this works, okay. Every thing will have it a little bit different, so I guess here I put the CapEx as a positive number. So we can do that. Then that'll subtract it out. And then change in net working capital, we still have to throw in here. So yeah, the first part of building the DCF is you always just input the historical data. We'll look at it, and then from there, we'll go ahead and make projections out for the future. So here we go, current assets. So this should be on the balance sheet. So we actually don't have 2017. I didn't go back and pull that balance sheet, but we'll start with 18. So for current assets, really, we don't want to include cash. So we're just going to do accounts receivable, inventory, and prepaid. So that'll be our current assets. And once again, I just changed the formatting real quick. Just delete that, there we go. And then make this green. So there's current assets. And then now we'll link up current liabilities as well off the balance sheet. Just come look at what we have. We have AP. We'll do accrued liabilities. We're not going to do deferred guarantees, customer deposits, or current debt. So we're just going to do those two. You can go look up a net working capital kind of breakdown if you want. Some people just do current assets minus current liabilities. A handful of things in there that I just kind of like to ignore. I really look at it as like the cash and running the business, like how are things changing from just collections versus payables, more or less. And then if you're building up inventory, some people like to do all of current assets minus current liabilities. You probably talk to an academic and they tell you something different as well. So take it all with a grain of salt, I'd say. But then let's see, what is this? These formulas are not linked correct. Let me paste those over. There we go. Now we can see how that's trending. And let me actually just copy the formats over. So there we go. So now we can kind of start to look at things here, see how things are kind of trending, plug in some estimates here and kind of see how we think things are going to look. So I guess the first thing here is we want to start inputting our projections. And usually I'll make these blue if it's a hard-coded value. So automotive sales growth, I mean, we can see it actually kind of slowed down, right? 17 to 18, it doubled. 18 to 19, it's kind of flat. Here, you know, I'll probably, I'll give them credit, say they can hold that constant for a few years. So I'll probably hold that steady for now, assuming, you know, they introduce a couple new models, new trucks, something of that nature. And then from there, we're going to say, you know, market's pretty saturated and we're going to have you start decreasing 1% a year as we go into kind of a perpetuity. And this might even be too aggressive, honestly. We'll see. Other sales growth, I mean, that's growing at a pretty healthy clip. So I say we hold that at kind of similar for now. Let's hold it, and then we'll have it start decreasing by let me do 3% for now, just so it kind of comes back to like a mid-teens. And right now we're just trying to see if we can back into their current valuation. I don't know if that's going to be possible. I don't know if these assumptions are going to be too low, too high, and where we kind of come through on all of this. We'll actually just oh, oops. Did I do that wrong? No, that's other. Okay, yeah, no, that's set up as other. Yep, okay, cool. And then total, we're actually gonna have this just be a formula. So once we put it all in, we can see how overall is growing in comparison to the two segments. And we'll do the same here with this. So this actually we'll change that back to black to show that it's a formula. So COGS, I mean, it looks like COGS have been steady, but I mean, they keep claiming that their new battery factories are going to decrease COGS. So, you know what, we're gonna decrease them at 2% a year and hold them steady at 65. That I have no idea, to be honest. We probably need to go look at Ford or GM and see how much it actually costs to make a damn car to get a fair analysis there, but we'll see. And then other COGS as a percent of sales, obviously that's not sustainable. They're selling these other things at a loss. Solar and stuff is supposed to become more affordable, so we're gonna say they're gonna lose 5% a year until they get down to a much steadier, better rate. SG&A, that's actually a good sign that they've kind of been decreasing that as a percent of revenue. So we'll just hold it here. We're going to assume, you know, they have to invest in growth along with revenue growth. CapEx as a percent of revenue. So, I mean, they've made a lot of investments in their facilities. So at this point, it's probably a lot more maintenance CapEx, things of that nature. So maybe we'll just leave this at kind of where it's at, around 5%. And actually, let me get rid of this negative sign. There we go. So we'll just leave that there for now. they're going to have to make some investments. And then depreciation is CapEx. This shouldn't be 160%. This should probably be something like 80%. Oops. Um, this have a negative in front of it too. Okay, let me just kind of fix some of these formulas real quick. So I mean, they're gonna be depreciating, but in theory, it's gonna be they'll have new CapEx every year, not just maintenance CapEx. So it won't be 100%. It'll be a little bit less. Depreciation amount. This should actually. Oh, this row's gotta update the formula. That's why it's not showing through. So there we go, and we can just actually just copy this formula across. And then once we kind of put in our CapEx estimates, that'll flow through. Here I'm just going to take an average. So what is that, 21.7 and 26, so that's pretty high. So maybe they get better at, I guess, collecting sooner and paying later as they grow and become more credit worthy. So maybe instead of having this be a use of cash, maybe this becomes a source of cash. So what we'll do, I'll actually hold that flat. Let me make this blue. We'll do the same thing here. And then we're actually I'm gonna have this decrease and say over time, working capital is actually gonna be a source of cash, not a use of cash. I mean, that's like ideal, right? They should be able to extend their payment terms and shorten their collection terms, especially because it's consumers, is a lot of their receivables, so they shouldn't be too long of credit, I guess, unless if they're financing it themselves or something. Not entirely sure how all of that actually works, but we'll see. And then let's copy this over for now. So now we're going to go ahead and kind of link some of this stuff up and get everything kind of flowing. So for 2020, we're going to take prior year times 1 plus our growth rate. Go ahead and do that. Copy this across, and I mean, let me just confirm, is that billion? These numbers have to be billions, right? Oops, I probably actually didn't need to scroll down there. So let's see. In millions. Okay, so yeah, these numbers are in billions. So I mean, I guess 70 billion in sales by 2030, going from 23 billion. That's probably fair. Copy the formula over. There we go. So I mean, maybe their other line isn't actually gonna catch up that well, but let's see. How does their overall sales growth go? So we're giving them about flat, increasing a little bit in the next few years before they slowly decrease back. That's probably a fair assumption. And now we'll get in their COGS. Let's see how that comes across. Do that. That should all just link up. And let's see, COGS is going from 83. So I mean, we're giving them a lot of operational efficiencies here. We're assuming they're growing pretty well. And if we look at their gross profit, right, it continues to grow at a healthy clip, which, I mean, that might be a bit of a stretch, but we'll see here. And let's go ahead and total revenue times percent SG&A. Realistically, we could probably actually decrease our SG&A because their R&D might go down in the future, but we'll see. So then there's their EBITDA, D&A. I actually think this is calculated down below based off just being a percent revenue. So that'll be once we plug in the CapEx, that'll flow through there. So now we just got to come down here and do the CapEx. And if we're doing it as a percent revenue, do that and come up here as a percent of total revenue. I think this one I have to update the format as well. Sorry about that, guys. There we go. Go ahead and paste that across, and now we'll see everything kind of flows through. So 2020, we're actually saying they're not going to have is it from the did I do this? Oh no, I guess I actually for their networking capital, I guess I did that the wrong way. My bad there. So they actually are. It already is a. I was thinking that this was the change. So I was thinking the increase there was a use of cash when in reality it already is a source of cash. So that's good. So maybe we'll actually just hold this steady for now. Um, we'll give them credit and say they get to keep using that as a source of cash. So we'll see their unlevered free cash flow slowly grows, right? So I think this is a pretty rosy picture. Oh, this table's all wonky. That's fine. Weighted cost of capital, this is really like what is the expected return we would need as an investor to invest. I mean, historically, the S&P is like 10 to 11% before inflation. Real returns are closer to like 7%, but so we'll start with 10. Let's do a NPV here. We got to change all the formatting once again here. Oh, this is kind of all sorts of rows, but go ahead and update that real quick. So we're saying NPV is about 40 billion, terminal growth rate 3%. Based off that, the terminal value of the company here, and then when we NPV that, oh man, so we're not even close to their current valuation. That's scary. I felt like we were pretty generous here. And then we still have to change out or subtract out net debt to get the equity value. So if you're not familiar, net debt is just total debt less cash. So let's see here, what do we have for total debt? Let's do current portion plus, no, that's, yeah, I guess that would work. And we'll subtract out their cash. The net debt number might be a little wonky. So they have a positive debt value. Actually, I think this might be, yeah, that we need that to be a subtraction. So with our current projections, right, we're saying that this is $140 billion market cap. Let me just move these real quick and we can see our sensitivity table. So even if we were to give them credit for saying they can grow 4% indefinitely and lower our rate of return, right, then you get about 265. So let's say we actually required like a 5%, right? Like if you take a 5% return on Tesla, if that's your baked in assumption, and you know, I mean, I think these growth assumptions are aggressive, right? Like I think if everything goes perfect at Tesla, you know, maybe they hold current growth levels before tapering off. That's probably fair. We see some improvements in COGS, so in manufacturing, especially out over 10 years, and who knows what will happen by then. And you know, maybe if they move to more software sales kind of on their cars, stuff of that nature, you know, you're gonna have a much better margin. So it's definitely possible to see the margin expansion here. But you'd have to be willing to accept a 5% return to get their current valuation of what, 578 billion. I mean, so yeah, 578. I mean, let's see if we take a, yeah, I mean, you need a 5 to 6% return with kind of what I would still call aggressive growth assumptions. I think prior to this crazy run they've experienced, right? Like, I mean, at what, 71 a share, right? So take their market cap, 600 divided by 9, that's what, a $65 billion company roughly. I think, you know, at 65, like right, the growth assumptions don't have to be there. They can make a lot of mistakes, right? If you only required say a 7% return, right? This would be a steal if you believe these assumptions, which is kind of like these are like the minimum assumptions baked in now. which is freaky, right? Like, I mean, if you were to drop these down to like 8% and 20%, I mean, you could even go lower, right? You could probably go 5 and 10. You're saying like they only got to grow 6% a year. Probably don't even have to have such aggressive expansion here. We could probably just hold this constant, honestly. And I mean, yeah, that other would still drop. SG&A holds flat, right? I mean, you're getting much closer to their old valuation there with a 6% growth rate. Um, so I mean, it is pretty crazy how much their growth is shot up this year. Part of it could be retail investors, massive speculation, obviously. Elon loves being in the limelight. People seem to like that, so things have been going well, but um, definitely a pretty high um, valuation right now. But with that said, I mean, if they can hit these milestones and or these growth numbers, right? I mean, it could still turn out to be a pretty good play if the solar business actually grows way quicker than 30%, right? If solar is the future, you could have to, pretty good, compelling company for the future, especially with a lot of these states and countries saying they're getting rid of combustion engines and moving to electric by 2030 or whatever it is. It could end up being pretty good, pretty good company to buy into, but at a $600 billion valuation, I mean, they got to be growing 20% a year over year, and already being a $25 billion revenue company. You don't see many $25 billion revenue companies growing 20% a year. You're going to saturate the auto market. You have, the Porsches of the world coming out with electric cars, Mercedes, BMW, everyone kind of competing in that space now. So it's going to be a tough road ahead. But I guess we'll see how things kind of go and see if they can actually, keep their foot to the pedal, I guess, to say. So thanks for watching. I hope you found this video useful, kind of insightful. If you have any questions or comments at all, feel free to leave them below and I'll make sure to get back to you. Thanks so much for tuning in today.